This is not a normal precious metals day. Silver didn't just go up, silver ran. In late December 2025, it broke into record territory above $70, with major outlets tracking fresh highs in the low $70 range. And here's why that matters. When silver is quiet, you can treat it like a line on a screen. When silver is violent, you have to treat it like a supply chain. Because squeezes don't start with a chart. They start when the people who build things, the manufacturers, quietly realize we might not be able to source this on demand anymore. Now add one more ingredient to this fire. A rumor is moving through the EV and connector world that Tesla's 48-volt architecture forces a reliability upgrade, and that upgrade may drag more silver into every car than the market is priced for. People are calling it Tesla's silver bomb, not because Tesla is secretly stacking bullion, because standards spread faster than mines. And in the last 24 hours, the market started acting like it believes the Standard Shock story. In this video, I'm going to give you value, real value, not fluff. What the tape did with China as the key signal sex. What 48 volts really changes without pretending we have secret Tesla spreadsheets. The only math that matters, assumption by assumption, so you can audit it while. The skeptic's case, so you don't get played. And the exact indicators I'm watching to tell hype from a real physical squeeze across. Let's go. The breaking number. What $73 really means. First, the number. Reuters has documented the move through late December 2025 silver, making record highs, breaking above 70, then pushing further into the low $70 zone in the same week. Whether you're screen printed $72.70, $72.75, or flirted with the $73 handle, the message is the same. The market just crossed into a price band that forces behavioral change. Because $73 isn't just a price. It's a psychological door. When a commodity walks through a door the public thinks is too high, you get 3 new characters in the story. The chaser, I can't miss this. The coverer, I can't stay short this. The allocator, I can't risk being unable to source this. And the allocator is the one that creates a squeeze. Now, for my viewers in India, this wasn't just a Wall Street headline. India's domestic prices spiked too, with MCX silver hitting a record around 23,359 per kilogram on the 24th of December 2025. That's not a gentle store of value rally. That's a stress signal. So the obvious question is, why now? Inflation didn't wake up yesterday and decide to do cardio. Something else is pushing this. And the fastest way to check if the something else is physical is to look at Shanghai. The Shanghai signal, where paper stories get exposed. Here's the cheat code for silver. If the story is real, Shanghai will tell you. The Shanghai Gold Exchange publishes an official Shanghai silver benchmark twice a day, AM and PM. Now, I'm not asking you to memorize the benchmark format. I'm asking you to understand what it represents. Physical pricing inside the world's most important manufacturing ecosystem. And right now, multiple trackers converting Shanghai pricing into dollars show Shanghai trading materially above Western reference prices, a premium. Translation: China is paying more for the same metal. That split matters more than the headline number because inflation is global and slow. A premium is local and urgent. A premium is what you see when metal is being pulled into a region, delivery is constrained, or someone with real demand decides they need to front run the queue. And yes, social media will exaggerate the size of the premium. Ignore the screaming. Watch for persistence. If Shanghai stays above the West for weeks, that's not a meme. That's procurement. And procurement is where this Tesla rumor gets dangerous. Quick primer. Paper price versus physical price. Before we go deeper, you need one clean mental model. There are 2 silver markets happening at the same time. The paper market, futures, contracts, options, leveraged positioning, the world of price discovery. That's where you get violent candles, margin calls, and headline highs. The physical market, bars, coins, industrial feedstock, real delivery. That's where you see premiums, shortages, and allocation. Most people watch only the paper market and assume it is the market. But 2025 has been the year where the physical market keeps interrupting the paper market. That's why London can trade at a premium to US futures during a squeeze. Shanghai can pay more than the West. And India can show double-digit premiums when metal is hard to source. So when I say $73, I'm not worshiping a number. I'm asking, is the physical market confirming the stress? If it is, the rally is harder to dismiss as just speculation. What Tesla actually did, 48 volts is not a meme. Now let's separate fact from fantasy. Fact. Tesla has pushed a 48 volts low voltage architecture in Cybertruck. Tesla's own Cybertruck owner documentation explicitly notes the vehicle uses a 48 volts low voltage battery instead of the traditional 12 volts battery found in many conventional vehicles. And this is not just Tesla being quirky. In the broader auto world, 48 volt systems are adopted because higher voltage can reduce current for the same power, which allows thinner wiring, less copper, less weight, and easier routing. Texas Instruments explains that 48 volts can reduce wire harness, gauge, and weight, saving copper and manufacturing cost. Industry discussions echo the same. Higher voltage, lower current, lighter harness. ConnectorSupplier.com. Now, a fair point. Some analysts argue EVs don't need 48 volts the way mild hybrids do, because EVs already have a high voltage traction battery and can step down power. That debate exists. But Tesla's decision still matters because Tesla doesn't wait for consensus. Tesla makes a bet, ships it, and forces the supplier ecosystem to respond. And that leads to the hidden trade-off. 48 volts is less forgiving, and less forgiving is how you end up paying for reliability materials. The arcing problem. Why 48 volts changes the rules. Let me make this tangible. Picture a tiny gap between two metal contacts. You open and close that contact thousands of times. Every time you switch, you risk a micro arc, a tiny lightning bolt. At 12 volts, you can get away with messy design. At 48 volts, the risk envelope changes. Texas Instruments discusses that moving from 12 volts to 48 volts increases creepage and clearance requirements, design parameters that exist specifically to prevent arcing. So 48 volts forces bigger spacing, better insulation discipline, better connector design, and more robust switching components. Now listen to Tesla's tone in its own DIY documentation. Tesla warns that because the 48 volts low voltage system operates at a higher voltage than typical low voltage, there is increased risk, including arcing and component damage if handled improperly. That is Tesla telling you, in plain language, treat 48 volts with respect. So the rumor doesn't have to invent physics. The physics is real. The question is, does respect translate into more silver demand in practice? Where silver enters the story. Contacts, relays, connectors. Silver's superpower is not mystery. Silver has extremely high electrical conductivity, which is why it appears in electrical contact surfaces and connectors. But pure silver is soft. So in real switching applications, you often see silver alloys and silver metal oxide materials engineered to resist arc erosion and welding. For example, silver tin oxide is widely discussed in the electrical contact world because it improves resistance to arc erosion and welding under switching stress. As voltage rises and reliability requirements tighten, the design space shifts toward contact materials that survive arcing. And here's how a small materials choice can scale into a market event. Cars are not one big silver part. Cars are thousands of small contact events. Relays opening, closing, connectors, mating, unmating, power distribution nodes, safety disconnects, and the whole messy world of real conditions, heat, vibration, moisture. So, if 48 volts pushes even a modest increase in silver-bearing contacts per vehicle, and that standard spreads, the ounce math starts to matter. But we're not going to vibe the math. We're going to audit it. The viral claim, 25 grams, 60 grams per car. Here's the viral number you've probably seen. A standard EV uses around 25 grams of silver. A 48 volts Tesla Future EV uses around 60 grams. Is that exact? Unknown. Is it directionally possible? Yes, but here's the trap. Silver per car is not one measurable thing, unless someone defines the boundaries. Are we counting only low voltage contacts, or also high voltage traction components, charging infrastructure, robotaxi depots and fleet buildouts, grid upgrades, solar expansion that comes with electrification? If you don't define the box, you can pump any number. So here's the disciplined way to handle it. Instead of believing 60, treat it as a stress test. What would happen if the higher number was even partially true? That's the math the market is reacting to, not the exact grams. So let's do the math out loud. Convert grams to ounces. We're going to go step by step. 1 troy ounce is about 31.1 grams. So 25 grams is approximately equal to 0.8 ounces. 40 grams is approximately equal to 1.29 ounces. 60 grams is approximately equal to 1.93 ounces. Now, compute the delta. If the world shifts from 25 grams to 60 grams, the increase is 35 grams. 35 grams is approximately equal to 1.13 ounces. That 1.13 ounces is the extra demand per vehicle in the stress test. Now we pick a production base. Tesla alone is not the bomb. Let's be conservative and use what Reuters has reported analysts expecting for Tesla's 2025 full-year deliveries, roughly 6 million. So if Tesla alone switched and the delta was real, 1.6 million vehicles times 1.13 ounces is approximately equal to 1.8 million ounces. Pause. That's big, but it's not the end of the world. It's not the 50 million ounce secret. So why is the market acting like it is? Because the real thesis is not Tesla. The real thesis is standards spread. Tesla doesn't need to build every car for Tesla to matter. Tesla's influence is engineering culture. If it works, people copy. If it saves costs, people copy faster. If it becomes a connector ecosystem, suppliers push it everywhere. So let's scale the delta. Scenario A, 5 million vehicles adopt 48 volts. Silver heavy reliability, 5 million times 1.13 ounces is approximately equal to 5.7 million extra ounces. Scenario B, 10 million vehicles is approximately equal to 11.3 million extra ounces. Scenario C, 20 million vehicles is approximately equal to 22.6 million extra ounces. Scenario D, 40 million vehicles is approximately equal to 45.2 million extra ounces. Now we're in the 50 million neighborhood. Now it's not a Tesla story, it's an automotive architecture story. And this is where the physical supply side becomes the villain. Why supply can't just ramp? The byproduct problem. Here's the supply side truth most investors don't understand. You can't just decide to mine more silver tomorrow. Reuters has pointed out a key structural constraint. Global silver demand has outstripped supply for 4 straight years, and around 70% of silver is produced as a byproduct of mining other metals, limiting how quickly output can respond to price. That means silver supply is chained to the economics of lead, zinc, copper, and other mining activity. So when demand rises fast, you don't get an immediate supply response. You get inventory drawdowns, premiums, and rationing. This is why deficits can persist, because supply is not a faucet. So when a believable story hits a market that's already tight, price can jump simply because the system has no slack. Why this move feels like panic? We've seen the system strain already. Here's the part you need to understand. December didn't create this fragility. 2025 did. Reuters reported that London, the world's biggest over-the-counter precious metals hub, experienced a spot market liquidity squeeze earlier this year, severe enough that silver traded at a premium to US, COMEX futures, and even made air freight deliveries profitable. That is not normal. Air freight is what you do for gold, not for metal. Everyone calls plentiful. Reuters also reported concrete numbers that explain why the market is so jumpy. A trader estimated about 15 million to 20 million ounces of US-based metal arrived in London over a single week to to ease the squeeze. Reuters. Another source said at least 1,000 tons of silver flowed into London vaults from the US and China. Reuters. LBMA data cited by Reuters showed London vaults held 24,581 tons as of end September, but strategists noted most of that inventory is spoken for by silver-backed ETFs, with metals focus estimating 83% allocated to ETFs. Reuters reported that about 697 tons left COMEX warehouses after U.S. stocks hit record highs earlier in October. Reuters also noted Shanghai Futures Exchange warehouse inventories fell to 920 tons, the lowest since May, with the largest weekly outflow in 11 years. Reuters. Put that together and you get a market that is not just bullish. It's thin, it's stretched, and it's sensitive to stories that suggest future industrial demand is about to get stickier. Now, bring India into the picture. Reuters explained that in India, premiums jumped as high as 10% over global prices during the festive season, and physically backed silver ETFs even suspended new subscriptions because they were being forced to pay hefty premiums for metal. And Reuters reported that in London, lease rates, the cost of borrowing physical silver, rose to more than 30%. That's the kind of stress you see when metal is not freely available. So when you see silver ripping towards $73 in December, you're not watching a random candle. You're watching a system that's already been living on the edge. The floating inventory illusion. Why the world can look full and still feel empty. Now let me explain a trick that fools almost everyone. People hear London has 24,581 tons of silver in LBMA vaults, and they picture a warehouse with a giant for sale sign. But that's not how it works. Reuters cited LBMA holdings at 24,581 tons, and in the same breath, strategists noted the brutal reality. Most of that inventory is already spoken for. Metals Focus estimated that about 83% of London vault holdings are allocated to silver-backed ETFs. Let me translate that. Allocated means promised, reserved, not floating. It's silver with a name tag on it. So the market can look full on a spreadsheet and still be dangerously tight for the people who need movable silver, the kind that can actually be delivered into a manufacturing chain on short notice. This is why the phrase "London is empty" is usually wrong. The smarter phrase is "London is not empty of silver." London can be empty of available silver. That distinction is everything, because when only a thin slice of inventory is truly floating, a modest surge in real demand can create a violent repricing. That's also why 2025 saw strange behavior. Air freight, regional premiums, sudden warehouse drawdowns. When the float is small, the market becomes jumpy. And jumpy markets overreact to believable future demand stories like a 48 volts architecture wave. So the right question is not how much silver exists. The right question is how much silver is free to move right now at any price. How to see a premium yourself. No magic, just math. If you want to stop being dependent on influencers, here's a simple way to verify the premium concept. Pull a Western reference price spot or front month futures. Pull the Shanghai silver benchmark SHAG from the Shanghai Gold Exchange. Shanghai Gold Exchange. Convert SHAG into USD per ounce using the day's FX rate and unit conversion, or use a reputable tracker and then sanity check it. When trackers show Shanghai pricing several dollars above Western quotes, that's the premium. Now here's the important part. A one-day premium can be a timing mismatch, a holiday effect, or a logistics glitch. A multi-week premium is a signal. A multi-week premium says people with real demand are paying up because they don't want to wait. And that's exactly the behavior that turns a rumor into a real squeeze. Now back to the last 24 hours. Why the Tesla rumor lands so hard? So when a rumor hits that says, by the way, the next design standard could pull more silver into every vehicle, the market doesn't need proof. It needs probability, because manufacturers don't buy certainty, they buy insurance. And insurance buying is what creates premiums, hoarding, and sudden price repricing. That's why the Shanghai premium matters, because it shows where the insurance is being purchased. The proof ladder. How this channel treats rumors. Let me make a promise on this channel. We don't believe rumors. We run them through a proof ladder. Level 1, a rumor is a story. It might be true, it might be marketing, it might be a misunderstanding. Level 2, a rumor becomes interesting when it matches known constraints. 48 volts is less forgiving. Creepage, clearance, and arcing are real constraints. Silver contact materials are a known reliability tool. Level 3, a rumor becomes dangerous when the market is already stressed. 2025 showed premiums, lease rate spikes, and even unusual logistics flows. Level 4, a rumor becomes reality when we see confirmation in boring places. Supplier BOM estimates, connector data sheets, OEM service documentation, procurement lead time quotes. So here are the 7 questions I use to audit the Tesla silver bomb claim. Is Tesla actually migrating more models to 48 volts, or is this limited? We know Cybertruck is 48 volts. Tesla, the rest is what we watch. Does 48 volts increase the count of switching events and connectors? A zonal architecture can reduce copper, but can increase node complexity. If node count rises, contact count rises. Are high-stress contact points being upgraded with silver-based materials? This is where TE connectivity, materials papers, matter more than influencers. Are industrial buyers showing insurance behavior? Premiums, subscription suspensions, and procurement stress are insurance behavior. Is Shanghai paying up persistently? If yes, someone with real demand wants delivery. Is visible inventory leaving warehouses? Reuters documented meaningful movements and drawdowns earlier in 2025. If that resumes into year-end highs, that's not just speculation. Do pullbacks fail to reset the market? In a hype move, pullbacks are sharp and deep. In a physical move, pullbacks are brief and buyers step in. That's the audit. And that's the difference between analysis and entertainment.